Well, thank you so much, and thank you so much for bearing with us. I mean, you have American emergency, but actually it's building momentum, right? So I see more people, which is great. I will not ask anyone to come more like here because I know people want to spread. But again, thank you so much for being with us today. I think, we have an impressive lineup of speakers, but also we're going to have a great engaging conversation. And again, also thank you for coming because another conversation on private sector mobilization, right? There's so many that we have, and it's always the same, right? It's saying, well, how we actually do that. I think the difference today is we actually have people from the private sector that are actually doing that. For obvious stuff is that in many of these conversations, we are missing the lens of the private sector. And I think, also the other difference here is we would have also the views of the public development banks, which in many ways, they're going to be critical to do that. Today, just in the session just now, there were voices from the private sector saying there is no way we are going to be able to have success in mobilizing capital without the role of the PDBs, right? And I would say the work of the PDBs doesn't stop in the multilateral development bank. So with that in mind, again, we have a great array of speakers today. I think, we will try to gain some time. It's my honor also, I think I can retire after this panel because I have a lot of the people that I admire deeply in the lineup. So we are going to start with Jordan Schwartz. Jordan is the Executive Vice President of the Inter-American Development Bank. He will do some introductory remarks and scene setting. Inter-American Development Bank has been at the forefront of mobilizing capital, including with innovative structures. They have like IDB Invest, the IDB Lab. They have been leading things here in FIX from the very beginning. So Jordan, it's my real pleasure to welcome you to the stage.
Thank you so much, Rodrigo. Good afternoon. Thank you for this opportunity to speak. It's wonderful to be at this FIX gathering among so many colleagues from across the finance and development community. I think we're all here looking for a way to solve one of the most important development challenges together. It's an article of faith for those who work in economic development that infrastructure is the backbone of economic growth, right? This is what we say to each other and our constituents. This is what we hear from the places in which we work all the time. It's a core to productivity, job creation, poverty alleviation, and improvements in the quality of life. It connects people to jobs, businesses to markets, and communities to essential services. This challenge has been framed in our times as a financing gap. And our institutions and the countries in which we work have estimated what that cost of filling that gap would be in absolute terms and as a share of gross income according to our goals, whether it is achieving sustainable development goals on access or reaching environmental targets. In our region, Latin American Caribbean region, we estimate the infrastructure gap at about 70% more than what is currently being spent on infrastructure, an additional 1.5% of the region's GDP. The temptation is to present a simple story about the relationship between the infrastructure gap and finance, between finance and the role of national development banks, multilaterals, private sector. And the common narrative is there is this big gap. Second, the public sector doesn't have enough resources to fill the gap. And third, if we combine our balance sheets and use our resources to blend, to credit enhance, to guarantee, to risk mitigate, and other forms of financial engineering, then voila, we can mobilize the private capital that we need. We can fill the gap and get on with the business of development, improving services for our people. And there is a logic behind this thinking. It's really driven the G20 and MDB, say, narrative about infrastructure since at least Addis in 2014. Let's call this an aspiration. I think that there are a few caveats to this logic that could help inform our discussion today and our understanding of how to use the financing of national development banks and MDBs to resolve what is inevitably an infrastructure services gap, and one that does need massive financing, but it may need a few other things too. These caveats or clarifications can help us to confirm among ourselves that public and private finance are complements more than more than competitors when it comes to infrastructure, and that the policies and institutions that drive the performance of our service providers are as important as the financial engineering, perhaps even more. So the first caveat is that there's no free lunch. It's only consumers and taxpayers who actually pay for infrastructure. And that's relevant because we need to know how much more finance can flow into the infrastructure sectors. In order to know that, we need to know what the capacity is of consumers and taxpayers to pay for expanded coverage and rehabilitated assets and the recurrent costs of improved services. I think the second caveat is that many areas of infrastructure address externalities or public goods, and they suffer from currency mismatch. Particularly, this is relevant in urban services, water, sanitation, roads, public transportation, housing, and it's particularly acute in countries without highly tradable currencies or deep secondary markets. Third caveat is that foreign sovereign risk is the primary predictor of investment in infrastructure, both the incidence of investment and volumes of lending. So that's regulation, rule of law, transparency, integrity of contracts, and even more, at a more meta level, macro stability. That's what drives volumes of private investment, even more than contract types, pipelines of projects, or even the structures and the forms of transfer or blending. So policies and functioning markets are critical. The fourth caveat is that private flows tend to move towards single large assets, power generation plants, water treatment plants, airports, port terminals, maybe high volume highways. This is helpful for project finance. It's convenient for building projects that need to securitize dollarized revenue streams. However, these assets are part of network industries or utilities. They don't sit out there by themselves. And the systems have to work. The utilities have to be efficient and effective. They have to be financially whole in order for us to be able to expand the private finance going into those networks. It also means that project preparation is relevant, since the private sector moves into stable contracts and clear structures more easily than it moves into utilities with direct exposure to consumers and retail tariffs. The fifth caveat is it's kind of an inconvenient truth. It's that private flows into infrastructure are pro-cyclical. So those forces that impact economic performance also impact private sector ability to bring projects to financial close. In other words, every time we say or we hear, well, the governments are fiscally constrained and therefore we're going to see more financing into infrastructure, we have to realize that these things are actually correlated. They're not in opposition to each other. The downturns that hit fiscal accounts and the availability of public resources also impact the volatility of currencies, higher spreads, weakened consumer demand, and other factors that make private flows difficult. So what does all this mean for today's discussion and our plans of greater and more coordinated financing? When we put these caveats together, we realize the business of filling the financing gap is complicated. And we also realize that national development banks and MDBs are even more important than we may have thought. And our support might have to be broader than intermediating or blending. It means MDB and NDB sources of credit enhancement can help address the risks and the procyclicality problem. For countries that cannot quickly shift to full cost recovery tariffs, the kinds of secure revenues that drive most private investment, it may mean that NDB or MDB financing of investment is needed in the utilities and securing rights of way and the underlying networks that will make project finance possible, not only in the support at the power plant or the port terminal or the wastewater treatment plant. Right now in our region, about 72% of NDB financing in infrastructure goes to project finance, through project finance. And there may be even more opportunity in supporting the capacity of utilities. It means that local currency financing of NDBs is really critical, particularly in urban infrastructure and transport systems, basic services, and housing. It means multilaterals ourselves have to step up in offering currency hedging platforms wherever possible. And it means that we need to work with governments on the policies, the regulations, the pricing, the market functions, the enabling environment, including through policy lending. It's a little bit less sexy than closing a deal, but it's actually what drives the demand for transactions and for investment. So there's so much to be done, and it's clear to us that the partnership of all the financing institutions, particularly national development banks and funds, and along with multilaterals, is critical. So not only for helping deals to come to financial close, by bringing down costs of capital or extending maturities. But across the infrastructure investment challenges, the policies, the networks, the consumers, the underlying public good and merit good functions that make this sector so critical for development. Our remit is very specific, but is maybe broader than we may have allowed ourselves. And hopefully today we'll be able to talk about the expansion of that remit, of that mandate across our institutions. So thank you so much. Pleasure to be here.
Thank you very much, Jordan. Again, I mean, I think, there's a couple of the things that you put out there that we will be able to test, with our speakers, our panelists today. So following that, Jordan touches on a couple of things, but one of the things that he touches is the need of the gap, right, in project preparation and sort of the upstream support. So I'm very, very, very happy also to invite now to the stage to my dear friend Zhongxin Wang, right? She is CEO of the Multilateral Cooperation Center for Development Finance, MCDF. And I have to say, I have seen the growth of this institution, right, from the very beginning, and how critical it became now, right, to create, and everyone now is speaking and requiring of project preparation in actually early stage investments. And again, I mean, you are the front of doing that, also expanding, creating, bringing more partners in. So I'm very happy and honored also to invite you to the stage, Zhongxin, to do the same setting for this session.
Thank you, Rodrigo, for your warm word. So, distinguished guests, ladies and gentlemen, good afternoon. It's a great pleasure for me to be with you today to give some reflections on the critical role of the private sector in the sustainable infrastructure development and what the Multilateral Cooperation Center for Development Finance, MCDF, the institution which I'm working for, is doing to support this agenda in collaboration with multilateral and national development banks. There are three messages I would like to share on collaboration, complementarities, and the leverage. The first message is that we need everybody to collaborate in a coordinated manner if we are going to close the infrastructure gap in the developing countries. You know the numbers well, and estimated $7 trillion need to be invested in infrastructure every year to achieve the sustainable development goals. Although the loans and assets of MDBs total around $500 billion per year collectively, public development banks provide nearly 6 times this in lending, meaning $2.7 trillion annually in new financing. These numbers are impressive, but MDBs and PDBs combined still only make up half of the funding needed to close the gap. This is why the involvement of the private sector is indispensable. My second message is that MDBs and PDBs have unique complementarities in financial instruments and knowledges. MDBs financial instruments such as guarantees, result-based financing, and the catastrophic drawdown options and global currencies can complement the national and the subnational instrument and the local knowledge that many PDBs have. MDBs and PDBs also have complementary partners at the global and the national levels, particularly in the private sector. Their extensive network of private banks, financiers, infrastructure, asset managers, and operators is crucial in closing the funding gap. Collaborative effort with these partners are essential to attract private sector investment. My third message is that MDBs and PDBs need coordinated actions jointly with the government to leverage the private sector as a partner. I'm sure we will hear from our panelists about the joint work areas needed to attract the private sector, from solid project pipelines and project preparation funds to risk management and blended finance. We should also work on transparency and clear approaches for debt stability and strong standard that would make project attractive to the private sector while considering local contexts and capacities. So now, please allow me to set MCDF example on how we do that. MCDF was established 4 years ago as a global initiative designed to promote high-quality infrastructure and connectivity investment in developing countries through partnerships with MDBs and PDBs as well as government. We are proud to have 12 prominent international financial institutions as part of our collaboration platform, including Asian Infrastructure Investment Bank, African Development Bank, and Inter-American Development Bank, who are here today. In addition, 7 FIs have been accredited to assist our financial facility to get funding for their project preparation and capacity building priorities. So far, our finance facility has extended $43 million grant, benefiting 70 countries, leveraging $7.6 billion in underlying investment in the areas of transport, energy, ICT, and cross-border water resource management. And our work extends beyond the FIs. 4 out of 26 project preparation grants support co-financing between FIs and the public development banks to harness the complementarities which I mentioned earlier. This includes the BDMG in Latin America, Abu Dhabi Fund for Development in Middle East, the Development Bank of Kazakhstan from Central Asia, and the China Exim Bank in East Asia. We also support FIs to work with and leverage the private sector. For example, 2 of our projects with AIB and the 2 commercial banks in South Asia are supporting the development of green financing frameworks that will allow private funding access. Another project we support through the African Development Bank is working with commercial banks in North Africa to develop new green infrastructure banks and related business lines. At the same time, based on our cooperation modality, we leverage experiences from FIs to help other financiers deepen their understanding of project design and implementation standards. Our project with PDBs and commercial banks are helping them to develop environmental social management systems that align with international standards. And our training programs have attracted over 5,000 practitioners from over 100 countries and 80 financiers in the developing countries to learn from FIs in the sectors of procurement, climate smart infrastructure, PPPs, environmental social safeguard, sustainability, and anti-corruption. So inclusion, strong knowledge, and the financing partnership between FIs, PDBs, and the private sector are crucial to closing the gap in sustainable infrastructure services. We look forward to hearing from our esteemed panelists about the challenges they are tackling, the innovations they are developing, and the joint programs emerging. Rest assured, MCDF will be there to support these actions. Thank you very much.
Well, thank you so much, Jean. And again, I mean, both Jordan and Jean just discuss what are the things that actually public money can do, right? To actually do that. So we need to test that with the private sector, or the ones that are actually doing that in front line. The panel I have, I'm going to be starting to call. The way we do this, we have like 2 runs. So we have 2 panels. So we'll do this very efficiently. But I want to say a couple of things. One is the panelists that I'm going to be calling now, some of them, they have something in common, which is they had been actually able to do the crossover from multilateral development banks into the private sector, right, and actually being on the blended finance side. So, and this is not a straightforward thing. There's not enough, I think, of crossovers and people that actually understand enough from the public side, right, or the NDB side into the corporate, and then vice versa. So, without further ado, let me invite to the stage to the panelists today. First, Marta Postula from the National Development Bank of Poland, BGK. Marta. Then I'm going to be calling Sir Daniel Alexander HSBC, CEO HSBC Infrastructure, Finance and Sustainability. Recently adding that title also, Danny. And then I have Wuchon, the CEO of the Global Energy Alliance for People and Planet. And then I have obviously Leslie Masrop, CEO of the British International Investment BII. So again, I mean, I think, you know, now I have to take the stage with you there. Okay. Hello. So the way we'll do this is we'll have time for one round of questions, right? So you have to be very concise, very efficient, very powerful. I will start actually, Marta, I will leave you for the last. And the reason is because I want this gentleman to say all the things that are going on, how they want to engage with the PDBs, and then you will have to say, well, test that and tell us whether that's actually in the right direction or not, right? But again, I mean, I had Leslie with me. Leslie, hello. Again, you recently took the job on BII, right? An institution which has been at the forefront of taking risks, pulling public money to work exactly to do what I think Jean-Jean and also Jordan was saying, right? And actually mobilizing this. But things are not getting easier, they're getting more complicated, right? So, and I think it's a privilege that we have that you are coming, because I'm sure you're coming with your new vision, your things that are going well and you have to continue, but also the things that you want to do more and scale. And again, I mean, in particular in the context of financing commons, I would love to get your sense first, you know, your vision, things that you really want to scale speed, but also where you think the handshakes, not only between the PDBs, but also with philanthropic organizations, also corporate, you know, sectors actually, you know, do. And then I will ask you, again, it's an impossible task, but if there's one or two things, right, that you would like to see more of as we come out of the fix.
Thank you so much, Rodrigo, for having us, and it's good to see you again. I like your point about crossovers. You know, both Sir Danny here and myself have been in the multilateral development banking world, Danny now at HSBC and myself in BII. I think it is important to have that sort of cross-pollination of ideas between private and public and the public-private sort of multilateral banks. 3 or maybe 4 points I'd like to make very briefly in the interest of time. The first one is just introduction to BII. British International Investment is one of the oldest development finance institutions in the world. It was created in the sort of aftermath of the Second World War, 1948. So it already has existed for 76 years. One of the distinguishing features of BII is that we invest in markets that you would consider too risky from a private sector lens. You would also be surprised to know that we're mainly equity investors. So we take equity positions in frontier markets that the private sector would typically shy away from. By taking those investments, we are able to, create a halo effect and create a more conducive environment for others to follow. So we play a very important role in that regard. The second point I'd like to make is that the climate emergency has placed the sort of climate finance agenda right at the top of the development finance world. So whether it's MDBs, DFIs, so you will see going forward for our strategy, we will place a higher sort of ambition on climate finance. We already have a 30% target for annual target. We've succeeded in reaching 40%, and going forward, that will increase even more. Right. And the logic is very simple. As you know, all of our development work will be undermined by the climate emergency. Right. The second point I'd like to make is that BII now also have new geographies. We will focus on Southeast Asia, Vietnam, Indonesia, Philippines. These are not countries that traditionally have been part of our geographies. Right. And the reason for the shift in focus is also the fact that if we want to deal and be effective on the climate front, we have to focus on the high emitting countries. We've got a long historical track record of decades working in Africa, but the historical facts are, as you know, that Africa accounts for less than 5% of greenhouse gas emissions. So to be impactful on the global climate agenda, we've got to work in the high-emitting countries, South Africa, India, Philippines, Turkey, Indonesia. These are the countries that matter. To put it simply, in 2050, there's literally 12 or 13 countries that will contribute 50% of greenhouse gas emissions. Our futures are intertwined. Unless we are able to help these countries decarbonize and in the process use the green transition as engines of growth, we will not succeed. The final point I'd like to make is that BII will not now migrate towards these, what I would call more middle income countries and sort of undermine our traditional core work on the African continent. We will, in fact, continue to deepen our focus in these frontier markets. We have ambitions now, for example, just to close off, we met in Dar es Salaam at the M300 a few weeks ago. We have plans in Burundi, for example, which is a small African country, to electrify that country from 20%, where they currently have households electrified, to 70% by 2030, working in partnership with the World Bank, with the IFC, with MIGA, with other DFIs. That gives you a sense of the significant development impact that DFIs can have in countries on the continent. Thank you.
Fantastic. Leslie, there's one thing that you want to see out of that, something that excited about?
Sure.
Anything?
FIX was started 5 years ago. It is very important for us to record the progress because it seemed like a bit like a stuck record. I was in Colombia last year, the agenda, Cartagena rather, and the agendas always look the same. I think it's important that we record the progress that has been made and that we specifically put more emphasis on the idea of harmonizing, of simplifying, of bringing together the sort of standards, the development impact metrics. All of these things are quite bespoke in our world. If you look at, ADB, AFDB, and so on, all of us have our own ways in which we assess development impact. If we can simplify those, it will enable private capital mobilization more.
Fantastic.
Thank you.
Thank you so much. And also thank you for being so eloquent and concise. So I want to keep building momentum about exciting things. I think Danny might be very excited. I said, like, there's one that actually going to put equity first, laws, all those things. And again, I mean, many of us, right, also on that. So let me go down to Wu Chong. Another recent crossover, right, from INDBs to GAP. GAP has been obviously a lot of expectations about the things, and again, a very also scarce type of capital that you deploy. And again, similar to Leslie, Wu Chong, you came to GAP also with, I'm sure, your vision, your views of the things that you want to do more or you want to see more of, and what is the role that you want to play, but also what you asking from the other partners, right, in order for that to work.
Okay, thank you very much. This must not be a coincidence, this panel. Among us, we have about 50 plus years of MDB experience. What makes me happiest for being here is that all three of us can demonstrate there's actually life after MDBs. In a different world too. We have private sector, philanthropy and the bilateral as well. So everybody's focused on reducing greenhouse gas, providing access to energy, better livelihood, and everybody's focused on leveraging more private capital because everyone knows that there's not enough money or brain in the public space to meet the needs of the world. So GAP was set up 3.5 years ago in Glasgow with the support from Rockefeller, IKEA, and Bezos to establish an alliance to bring people together, 50 plus partners, to collectively take action to reduce 4 gigatons of greenhouse gas, 1 billion people access to energy, and 150 million green jobs out there. Obviously, it's a big ambition for any one entity to do alone, let alone just philanthropy, but we need to crowd in. So I know I don't have too much time. So the reason why actually I crossed over from MDB to here, to my space, is I love MDB. I was there for 31 years. Obviously, I love the MDBs, and there's so many things that MDBs can do. But MDBs were set up a long time ago with certain parameters, which is not so much embracing risk-taking. Because I still say the MDBs need to take, maintain the AAA and so on and so forth. But over the last several years, through push from G7, G20, and the developing countries, MDBs have innovated quite a lot, but there's still so much they can do. Certain type of investments cannot be done. So philanthropy I discovered two years ago or so, and I got to learn much more about it. It does have huge amount of knowledge and brain power in addition to money. And you'd be surprised how much money there is, not as much as the MDBs, but still quite a lot. But the key difference is that it's flexible.
Right.
It's scarce, but it's flexible.
Right.
And we are able to, if you do it in the right targeted way, take positions that nobody else can. The stack of investments, and we can go into ADB and HSBC. The first loss, for example, no one's going to take that, right? But if someone could take that, it will unlock huge stack of finance investments. So we want to. Our primary focus is to bring partners together and be a problem solver. In a developing country, see what is the problem, what kind of things need to be done. Is it just the capacity building that's needed? Is it regulation reforms and so on and so forth? And we would bring in existing partners, but then there are some innovations that we need to demonstrate that it works, so that the perception of the private sector is that a lot of times investments are too risky to make in developing world, frontier markets, frontier countries. So we want to demonstrate that projects will work with the right kind of structure and financing, so that you remove the perceived risk, so that they can come in. So that's something that we would like to do more of. But bigger scheme is bring the solutions together and come up with a formula that would work. The one question you asked, what would we ask you to tell people to do? Please do tell people with problems to come and talk to me. I will try to come up with the solution. Okay. Not necessarily we're going to do it, but we, I know even even among this group here, I'm sure we can come up with pretty good solutions or whatever it is. So we want to be that solution provider for the world to provide access to energy and decarbonize and green jobs.
Fantastic. And can I ask the same that I asked Leslie? One thing that you would like to see coming out of this, right? That we should do more. And again, Leslie mentioned harmonization and actually streamlining, which I think is very, very much needed also for the private sector. What is your wish?
Yeah. So basically making it easier to do projects on the ground, right? So that could mean harmonizing would help, getting more data, public good. The public data is actually really, really important. Harmonizing across World Bank and Asian Development Bank recently approved this thing called the Mutual Reliance Framework for Policy. So when they actually jointly finance same project, they decide to follow one or the other, not two different sausage machines. So those are all very good. And sense of optimism. We should come out of this meeting with optimistic feeling.
That's great. Okay. On that note, I'm going to go to Danny, my former boss, by the way. So Danny, you went to the core of the private sector, right? Obviously you have also a recent crossover, and you are now leading the infrastructure and sustainability business in HSBC, which is global, right? And again, there's lots of eyes on the private sector. And again, similar to Leslie and Woo-John, I'm sure you're coming with a vision and you're coming to things that you feel can be done differently, right? And things that need to continue doing. So we'll ask also for you to tell us a little bit about that. And then if you can pick your wish out of Fix, what that will be.
Thank you very much. And it's great to be here. I just wanted to say before I start that a gentleman had a health emergency here, and I think we all pray for his good health and quick recovery. So I joined HSBC about 4 months ago. The bank has been around for 160 years this year, so even older than BII, and has a kind of unique strength in connecting different parts of the world. Very strong in Asia, in the Middle East, in obviously Europe and the UK, and in the Americas. And I think that puts us in a unique position to be able to take some of the commercial opportunities that are there and that will come from the net zero transition. And that's what HSBC Infrastructure Finance has been set up to do. We have ambitions to substantially grow the infrastructure business, including in many emerging markets where we're present, in Greater China, in India, in Southeast Asia, in the Middle East, and so forth. These are really the kind of core of where the growth is going to come. And I think the first thing to say is that, you know, the private sector wants to invest in these places because they're the parts of the world that are driving growth. They're the parts of the world where most of the people live, where most of the growth has taken place in the last several decades. Also where most of the carbon emissions are. But there are also very significant risks. And I think sometimes in these, so one of the things that motivated me to join HSBC was because, and Jordan kind of hinted at this in his comments, that among public sector institutions, we've been discussing private capital mobilization, as it's called, I think probably wrongly, but anyway, I'll come back to that. I think Jordan dated it back to 2014, perhaps even longer than that. So that's a decade of these conversations. And I think that what's interesting to me about going to a private sector institution is then to see, okay, what do we really need? And how can this public system provide it? And this shouldn't be on the assumption that private sector institutions are somehow going to abandon their commercial imperatives in order to do this kind of business, but rather that through the collaboration, through the partnerships that we can build, that we can de-risk in some ways, and therefore create opportunities for commercial investment really to flow. So I'll just give a couple of examples. One of the things that we did at AIB just before I left was to introduce climate policy-based financing as a new instrument. And I think that the comments that several people have made about the importance of getting policy frameworks right. So you can look at two countries that have similar macroeconomic characteristics, and the investment will flow more to the one that has the policy frameworks that give security, that give a clear, sustainable cash flow, for example, to flow from the project that you're investing in, that has a secure regime for public and private partnerships, those kind of things. Secondly, project preparation. We talk about this a lot, but project preparation is more expensive and more costly and more time-consuming in emerging markets than it is in developed markets, probably twice the cost. And so the work that public institutions can do in that space is incredibly important. And then there are the instruments that can be deployed, the financial instruments for individual transactions or for platforms. So to give a few examples where HSBC has been involved. In Southeast Asia, we've created with Temasek a platform called Pentagreen, which is designed to invest in marginally bankable projects in Southeast Asia. We're scaling that up with many partners to turn that into a blended finance vehicle, very much supported by the Singaporean government and their FAST P program. I think we should take our hats off to the Singaporean government because they're really leading in this space, actually, in terms of their thinking about how to deploy public capital. Guarantees, they've been mentioned by several people, absolutely critical. For example, the guarantees that are provided by export credit agencies. I know export credit agencies are not part of FIX. Perhaps someone should consider inviting them. But export credit agencies, the guarantees they provide really help to unlock flows of capital that wouldn't, and the guarantees that MDBs provide and that public development banks provide, an instrument that really works. And then we can look at some of the other, kind of financial products, bonds, outcome bonds, for example. We just at the end of last year supported the World Bank in their first outcome bond directed at reforesting the Amazon, for example. So these are the kind of things that can happen by working together. And each of those could be scaled. And I think if I had my wish for FIX, it would be to say that every institution has its pet scheme, right? They have an idea. They have every government also, right? And so you see myriad really good initiatives. But we're not very good at saying, this really worked, here's how it worked, or this didn't quite work, here's the lesson. And what are we going to scale? And how do we share that knowledge about what's scalable across the PDB community? And I think that if FIX could play a role in not, picking winners is well, yeah, basically, but or at least sharing learning, so that the kind of the transmission of good ideas can go much more quickly, and then those things can perhaps be done in a similar way. People get used to them, scale those models across the PDB family.
Thank you so much, Danny. And I think, again, there are a couple of things now, like FFD4, a couple of these processes where, there's a lot of politics around, but actually at the bottom line should be this catalog of things that we want to see more of, and we should be less attached emotionally of who actually created them, and actually saying, well, this actually works, let's join it, right? So, Marta, you have been patiently waiting, thank you so much, but, PDBs are kind of the new kids on town, right? Like, now everyone is discovering PDB, have been forever, but, I think that fix is discovering, uncovering, right, the potential and really how powerful these institutions are, right, and how important they are in the architecture. So we would love to hear your views, right, again, at running one. What do you think is your sense of the role that PDBs can play in catalyzing this, and also what you're asking from the other institutions that you see today, right, and your wish for fix?
Thank you very much for invitation from this panel, and thank you for voice from my colleague, because I can say that it's all of this information and all of this point, it's important from institution like, for example, is BGK. BGK is 100 years institution. We are somewhere between, yes, I was listening very... Yeah, I hope. But this time it's important that this point which I said from colleague in our parent, we are doing, it's our daily work, we can say, and few main important issue. I was listening very interesting about this guarantee. Guarantee is working very well in Poland, and we are thinking that this instrument should be more should be used in more different, this kind of financial institution, because it's very concentrated how is this private sector money coming with this public money. This risk management is important, especially in this emerging country, that it's very difficult to find, sometimes not good project, but at the same time find enough money to manage of this risk of this project and preparing of the project. And in this element, it's very important, this kind of national development bank and national institution who should support and can support with some of mix of the grants to how to preparing this project, and after this how to finance of them. And when you're looking from example from Polish experience, from BGK experience, we have some special products which are some of mixed grants and loans. At the same time, when this project is preparing, we can going to the market, private market, and finance them with the different commercial institution, not only Polish institution, but at the same with some international institution. The huge project which we have is some of offshore, which are very costly project, but at the same time it should be good preparing in this national level, and after going to the market. And there, like your colleague said, the money is not a problem, because we can find the money, but at the same time the problem is to find good project and prepare them. And from this perspective, it's very important, the function of this National Bank of Poland. When you're looking from our experience, 100 years experience, and it's important that we find some of element connection between our government, European institution, because we are managing a huge part of the EU money which are connected to the infrastructure transformation. It was road, railway, and now energy transformation. And we are manage them. And our function is important to, first of all, to find this project in this preparing and try to manage risk, because very often from this commercial institution, and my colleague said that it's to find what kind of elements is important from the government, what kind of project will be support from the government. At the same time, this National Bank, Development Bank, can support and be like a catalyst of some of project, that if we are invest money from them, this is important from the government. It's easier from the commercial institution to do it. And from this perspective, we can observe that international, for example, like in Poland, it's some of commercial international institution from not only from the Europe, but at the same time from different market coming to us, say we are looking for a good project. Right. We are looking, but it should be preparing, right. But we want that you will be in this project as well. We don't only coming with the money, because you are like a representative of your government and you know what's going on. This is very important, and maybe because of this, it will be some of increasing of responsibility, but at the same time to function of this National Development Bank in Europe. Second point is the cooperation between this kind of institution, because, for example, this exchange of view, very often we are doing like the European Development Bank. We have some special board, special organization, and we know exactly what kind of project is enough good for each country, and we can share some risk. We can be from some of them together. At the same time, in one country, this can be not enough money in National Development Bank, and there we can manage each other. And one more point, data, and yeah, this is important, yeah, because how to looking from this resources, and we're looking from this project, and how to do it, and to analyzing good data which are coming, it's very important as well, because it's easier to make a decision. And from this perspective, we are thinking that this function of this kind of institution, it will be increasing. Thank you.
Thank you so much, Marta. And again, I mean, as Danny said, I think we should make an effort to make more of this model of how you're doing these things actually, you know, more known to others, right? And again, because you are actually working on many of these handshakes. So thank you so much. Again, I will not summarize because I'm being very bad timely management, and I have to give the floor to my friend Anderson now. But let's first say a big round of applause to our panelists. You know, thank you so much for engaging. Having a pleasure. I can retire now. And then I'm going to invite Anderson to the panel, please, to take over. Thank you, Anderson.
Yes. Hello, everyone. As we are short of time and before all the names are there, we start here, then sit down there. Thank you very much, Rodrigo. Good afternoon, everyone. My name is Anderson Caputo Silva, the Division Chief of Connectivity, Markets and Finance at the IDB. No? Pleasure to be here with all of you. We are going to have an interesting panel with 4 panelists. Let me get them here without further ado so that we also try to manage the time shortly and have a quick session. But I would like to invite here Mr. Pradeep Kurukula Surya, Executive Secretary of UNCDF. Salomon Quainor, Vice President, Private Sector Infrastructure Industrialization of AFDB. Jorge Velarde, Chairman of COFIDE in Peru. And Kishore Kumbar, Chief General Manager and Chief Risk Officer, India Infrastructure Finance Company Limited, IIFCL. I hope your last name was okay to pronounce. Okay, taking the difficult seat here of replacing Rodrigo here. We're going to go straight to the point, and also and I'm going to borrow an idea that Rodrigo had, is that I'm going to ask a question to each of you coming from the perspective of your institutions, no? But in the end, I would like to ask, because we are not going to have just 2 rounds, it will be just 1 round. In the end, I'm going to ask also, what is your wish then for FIX, which was a great idea, Rodrigo, that we copy good ideas, no? We replicate. Yeah, exactly. So let me start with UNCDF. Pradeep, your institution has focused on your work programs in helping countries define programs for actions that then lead to strong pipelines. And this part here is really about enabling environment pipelines, no? What do you see as the role that multilateral and national development banks can play in supporting investments in sustainable finance infrastructures in emerging economies?
Thank you. Thank you for having me, and great to be on this panel. Well, first of all, I'm pretty sure all of you are saying, UNCDF, what is this? UN Capital Development Fund, you'll be surprised to hear, was actually set up in 1966. It was 1 year after the United Nations Development Program was set up. And it's an interesting history to dwell on a little bit, because you have to ask the question, why is it in 1966, against the emergence of the Bretton Woods institutions, did the UN dabble in finance? And I think there were some bankers in the GEA who understood that even though the emerging Bretton Woods institutions were necessary, you would have some parts of the world left out of capital markets. That was the essential genesis of UN's Capital Development Fund, to help countries left out of capital markets, to help them actually crowd in capital, because these were naturally risky environments. Unfortunately, UNCDF did not survive the Battle of Wills in the 60s, and it began to sort of wander on its own. I came into UNCDF last year, and I essentially put it through a massive reform process to take it back to what it was meant to be from the beginning, to essentially de-risk environments. Because there's one thing that I think we all recognize, because if everything was great and we had all the institutions functioning in the way that they're meant to, we wouldn't be here having this conversation. I think FFD is pointing that out very clearly, that in spite of the system that we have, there is a problem in that when it comes to risky markets, no one is set up to go in and absorb the kind of risks that are inherent in early stage markets. And these are untapped, unfulfilled promises. So what I want to try and do with UNCDF, and to get to your question here, is really to try and see how a UN platform, which is both a development institution, but a non-credit rated financial institution, because it's the only UN platform outside of the International Fund for Agriculture Development that can actually deploy loans and guarantees at concessional rates. We are grant funded, like most of the UN system, but we're able to absorb a higher burn rate than most MDBs or DFIs. And that becomes an incredibly important ingredient in the kind of ecosystem that we're trying to crowd in finance into, because someone has to go in and absorb that risk. So when it comes to infrastructure finance, I think we all recognize that this is not a issue where you can apply a one-size-fits-all solution. We're talking about different ways of managing risks. We're talking about different sectors that have different needs. And all of that means that you have to have almost a custom specific solution in the kind of ecosystem that you're trying to tackle. Secondly, I think what we have seen through our experience over the last few years is that sometimes, just as ODA and aid tends to crowd out private sector, it's also the case that sometimes NDBs tend to crowd out the private sector. Because as they try to also expand on their balance sheet, sometimes we find that investments that are prepared for the private sector to come in and finance are actually taken over by MDBs that actually blend them into some kind of sovereign loan, which is then financed. Great for the project, but not so great for the purpose of crowding in private finance. I think lastly, the point I want to make is that ultimately, for me, national development banks are critical. They are the ones that are going to stay there in the long run. They are the ones that are critical for unlocking domestic capital. They have to be supported. And we have to find ways in which the role of NDBs, in particular, the national development banks, are enhanced to play a much bigger role in channeling finance for infrastructure. And for that, we have proven that particularly at the subnational level, it is possible to unlock domestic finance. Our recent experience in Tanzania with the Tanga water bond, for example, with a $1 million investment at a sub-sovereign level, 20 million of domestic finance was raised. It was the first in the East African context. So these types of opportunities are there, but somebody has to take the risk in exploring them. And I think when you do find success, those have to be repeated.
Fantastic. Thank you so much, Pradeep. I think that in your speech, you talked about something that is coming already, like we just started today. A lot of the talk is being on the complementarity of the different actors, no? And then I think you brought this in a very nice way, no? In the way you brought. And we learned a bit of history too, as in the previous one. Let me go to the African Development Bank and Solomon. Based on the African Development Bank's experience in building pipelines of sustainable infrastructure projects in Africa, what have been the effective approaches? We mentioned here things to replicate. Now, to mobilize private sector in these alliances for sustainable infrastructure at scale.
Okay. No, thank you very much. First of all, I have to indicate I'm a little distracted because of the gentleman who had the emergency here. It's one of the reasons why we focus on healthcare infrastructure now. If this was not Cape Town and if this was in most other African countries, I think, the ultimate situation may have been unfortunate. We understand that he survived, so they've taken him to the hospital. However, let me come back to the original point. I'm relatively new at the African Development Bank, and the reason I say that is I started off in the IFC for 20 years in the infrastructure team looking for deals, right? And then with time, we learned how to work backwards because the ready deals were not coming. They were coming in Latin America, they were coming in Asia, they were coming in other markets, but they weren't really coming in Africa as much. And hence, projects in Africa were probably at what we'll say the bottom of the queue. Now I work with an institution that's dedicated to Africa. And, the approach has always been what I call a supply chain or a value chain approach. And so it's not really resolving matters at just one point. It's really resolving matters at different points in the value chain to be able to really attract private sector. Because private sector is not coming for altruistic reasons. Private sector is coming because they see the opportunity to make returns. But increasingly, we're also seeing the impact investor that also want to see impact. So let me walk you through the value chain, approach, because for us, it's really, that's the way you build a sustainable pipeline of infrastructure projects. So it starts off really at that early stage project development and project preparation. We use the terms interchangeably. But the way I like to look at it is that infrastructure project development is within the fence, right? It's what you do on the technical, the financial, the economic, the ESG aspects of the project itself. Project preparation relates to having the right enabling environment. In other words, how long has the regulator been in place? Are they really implementing the right tariff methodology, etc.? So both of them really have to work out well. We started to do it in an ad hoc manner at the AFDB. Then we realized that it's, especially for trying to get private sector, sponsors involved in project development, we needed to really have a more systematic approach. So this is why we created Africa 50, which is the preeminent infrastructure project developer in Africa. And in fact, the chairperson of Africa 50 is the president of the African Development Bank, just to show you the close ties. Yes, we continue to do project preparation for public sector projects within AFDB, but as we look at PPPs, as we look at private projects, we realize that we need to actually now take it a step further, and that's why we've launched the Alliance for Green Infrastructure in Africa. Now, project development has mostly been done on a grant basis, but we see that there's not enough grant money. I mean, I saw the gentleman from GIAP here. I mean, it's great to have philanthropy money, but there's not enough grant money relative to the needs on the infrastructure side. So we're pushing the envelope to say, okay, can we bring in junior capital? Can we even bring commercial capital to create a three-tranche structure that would actually now invest in project development, and then we find a way to recycle that capital for more project development. So that project development, project preparation aspect is important. So in the Alliance for Green Infrastructure, we're trying to raise 400 million for project development and 100 million for project preparation to really scale up green infrastructure development, do it with speed and with time. Now, this facility, some people think it's a facility just for Africa 50. No, infrastructure project development really happens at the local level. So the idea is that public development banks who are working with local developers can actually access this facility as well. This is a market facility where we want to create what we call a contestable market of project development and really get skills, at that level so that we can more rapidly create bankable projects. Now we go from there and start going towards the financing. You have a bankable project, but is everybody sure about it? So this is where we come in and we provide partial risk guarantees to counter-guarantee government obligations. Then from there, the next step is to really look at, okay, financing is being raised. Do we just lend or do we actually help with leverage? We have a AAA guarantee. So I heard Danny talk about the first loss. Yes, we don't mind taking first loss, but we don't want to really have first losses that are always realized. So this is part of the reason why we continue to work on the value chain. And then, yes, we're very happy to use, our AAA to also bring affordable financing into the system. But we've decided also to go beyond our own capacity and create African institutions that can do that. So in the case of Nigeria, we've helped with the setup of InfraCredit Nigeria that has credit wrapped really about $500 million worth of bonds in local currency Naira, over the last few years. We've now set up, a similar company in East Africa called the Mana Guarantee Company. And so here we're also using, African institutions to really mobilize local currency long-term capital into these projects. So it's not just us lending, it's really us crowding in and mobilizing so that we don't crowd out the private sector. Yeah. And let me recognize Hubert, who's here, who's actually been doing some great work around the pension industry, the 5% agenda. Hubert has been doing some great work in that because ultimately we need pension funds to not only invest within their countries, but also to be able to invest, regionally as well. So I just want to recognize he's really been working with the African Union, on that basis, because once again, mobilizing domestic, long-term, local currency capital is going to be very critical. Now, lastly, we always talk about private sector. There are several types of private sector. So there's the sponsor, like the SCATEX of the world and so on, who will come in at the project development end. There's the private sector lender that will come in with the credit enhancement for us. But the famous $150 trillion of assets under management are not going to come in and take construction risk, take ramp-up risk. So this is where we are also, using the model of originate to distribute. And so we've also done synthetic securitizations to bring in other parties. And we've also done securitizations of our own portfolio as well, because the idea is not to originate to hold. I thought he was coming to just indicate to me to keep quiet. But anyway, so once again, let me wrap up by saying, it's a value chain approach. And we, at the AFDB, look to really work in all aspects of it. But partnerships is very key. The InfraCredit and Damana I spoke about, we're doing it with the Private Infrastructure Development Group of the UK. They're our key partners. When we look at also those vehicles, we're working with a new cadre of public development banks, which are called sovereign wealth funds in Africa that have domestic obligations, but also strategic investment funds. To be honest, I wouldn't go and do an infrastructure project in any country without actually working with them, because they help me manage also the political risk in time. But let me stop there. Thank you.
No, Solomon, it was fantastic. I loved the value chain approach, because in a way it's a good segue for the discussion of how do you come in different parts of the project, from preparation and etc., and the role that can play. And you started saying that in Africa these things were not happening. It seems that now everybody has a lot to learn from what you're doing in Africa, in replication.
Can I just say one thing? I think
Yes.
Solomon raised an issue which I think is super important, and that is, yes, when you have a first loss guarantee, you don't want to necessarily utilize that. But this is where we have to partner, because actually I'm willing to lose it, because I'm dealing with guarantees with grant money, exactly aimed at absorbing the risk in an ecosystem that actually prevents you from going in because you shouldn't lose the guarantee, right? You have a AAA rating, which we want you to protect, because that's what's going to allow you to get cheap capital and so on and so forth. But this is where I think we're not joining the dots. So, a point I made in the ExCom committee was that it's not that we don't have collectively the instruments. We just need to be better at integrating.
Integration is what we are trying to discuss, and how to better work as a system, everybody. Roy, very nice that you made it. So we know that you're lost your connection, almost didn't make it. I really appreciate that you did the effort to be here. So based on COFIDE's experience, how do you see the potential of this type of alliances that we are talking between, like, multilateral development banks, national development banks, private sector, not to mobilize like we are talking here about private sector investments in sustainable infrastructure, and how do you plan to create this bankable pipeline? We are hearing here now an example in Africa, but how to create this bankable pipeline of sustainable infrastructure projects?
Thank you, Anderson. And first of all, thank you for having me in this high-level panel, and also my wishes for a prompt recovery for the person who wasn't well in this room earlier. And please apologize, I'm not well-dressed, as formal as this panel deserves, but happy to be here. These alliances are not only essential, but are multiplier in its effects because they combine resources, technical assistance, and help the national development banks, the public development banks, to increase capacities or to modernize. And that's what COFIDE is undergoing right now. Speaking about crossovers, I have only 1 year in COFIDE, and as soon as I joined, I promote the transformation of COFIDE to made of COFIDE a 54-year-old public development bank in Peru, and largely recognized for supporting financial institutions, especially for financing small, medium enterprises. But COFIDE was not fulfilling the task of mobilizing private capital, for instance. And there were several gaps to be recognized as a efficient development bank. We lacked the capacity of co-financing with other institutions. How do you mobilize a private bank if you cannot co-finance a project with it? So we started a restructuration process, and we also receive from the key multilaterals in the region, I would say IADB, with an important, not only technical cooperation and resources, but also the support of their team, and CAF. Both institutions allow us to retain consultants and prepare the team that would discuss with the government. And I believe in the system we need to include the government. We need to work with them, not only to align policies, but also to make them understand the needs to have their institutions working in the benefit of mobilizing private capital and finance, close the gaps for infrastructure. And, well, we persuade the government that we need to change, after 32 years, the legal framework of COFIDE. Now we are entitled to co-finance, where we have almost every financial instrument that will de-risk or mobilize private capital. Now it's allowed for COFIDE to enter directly with other institutions in the financing, and also we can provide additionality by giving technical assistance with our own resources, not just intermediate resources from MDBs. So I would say from COFIDE's experience, these alliances with MDBs are not only necessary, but we need to take them to a second floor, to the next level. And that's what we have entered, like a roadmap with each of them. IFC, for instance, is supporting us in corporate governance, in our new role as an anchor investor in capital markets, and in project financing for energy projects. On the other hand, we have CAF, who is working closely with our new bylaws. They will be our first equity shareholder, with common shares and with a right to vote in our and the right to appoint a board member, and that will help to foster our institutionality. And IADV, well, we have several lines identified that include foster productivity and develop new instruments like guarantees with our own balance, because COFIDE has a lot of experience managing, let's say, acting as a trustee of the government and providing guarantees, but with the sovereign as the provider of the guarantee, and taking the risk and taking the cost of providing these guarantees. And I believe sometimes Peruvian government is like suffering because it's a victim of its own success, because they believe, oh, we have a stabilized economy and we have access to capital markets in really good conditions. However, when you try to run the projects by your own, and instead of working with the system and benefiting of the knowledge and experience of the MDBs, for instance, you can ensure that the project will be done and will mitigate the risks during construction, etc. And with the guarantees, for instance, the projects, if they take all the costs, they are not making blended finance. They are not having the opportunity of mobilizing private capital, and that's probably the same issue we need to tackle for building an infrastructure pipeline. In the last year, we have been very close with Preinversión, which is the agency the Peruvian government promotes private sector investment, and they have awarded over $9 billion in new projects after several years of, let's say, silence. So we are very excited, and we expect COFIDE to be like an anchor financier for those projects, together with MDBs, together with the private sector. But perhaps not for project preparation. We don't have those capacities right now. We need other actors there. But for providing technical assistance to the local governments that need to issue permits for those projects, to provide bankability analysis for Preinversión, for instance, or before the financial closing. I believe there's a role for COFIDE to play, and in general for national development banks. The most that we can bring to the other actors to the table and build, let's say, a system solution, to put in your words, I'm sure we will be making a good effort to not only mobilize capital, but make sure that the projects get done.
Thank you very much, Roy. First of all, congratulations, because I have seen the new COFIDE, and then in the short period that you're there, like the expansion of the mandate that you have is fantastic now, and it looks like you're opening the path for a bright future and much more active COFIDE.
Thank you so much.
I also take as one of the core things in other parts that you mentioned, including the end when you're talking about bankability, the complementarity that you have as a national development bank, understanding the ground, building the capacity there, but also having, as you mentioned, like the role of multilateral development banks working with you, complementing with solutions, be it on the funding side or be in supporting project preparation and reforms, etc. No? Very good, and congratulations again for the great work you're doing.
Thank you, Anderson.
Let me pass to Kishore. Last but absolutely not the least, no? And we wanted to see, like, how do you see the role of public development banks in your area of work, and what are IIFCL's plans to engage with public development banks in the future? So it's, in a way, it's this part of working as a system.
Thank you very much. Before I answer your question, let me speak about what IFCL is doing, so that it will be clear for all the audience and panel member. IFCL is the institution incorporated in 2006 by the Government of India, after realizing the fact that government funding cannot be entirely funded for the infrastructure project. And thereafter, IFCL came into the, existence, and Government of India given the mandate that we can target only viable infrastructure project. It is not concessional funding, it is entirely commercial basis. And initial hiccups, there has been a lot of issues, but subsequently there has been change in the model, road model, and finally we concluded with a HAM model. And thereafter, since inception, IFCL has till now funded to 18 infrastructure sector, majorly road, energy, airports, power, ports, and urban infrastructure. Till now, we have been associated with 7-8 multilateral banks. That includes ADB, World Bank, JICA, AIB, and one more agency, KFW. So we have borrowed around $2.5 billion from them, and we have been complying with all their requirements. The issue here is, when I am dealing with 5 different or 6 different agencies, every institution has got different requirements. And most importantly, government guarantee. If I add that government guarantee fee, then cost becomes unviable for me. So now we have come out with one of the multilateral agency that can it be blended. So we concluded that deal, and there are 3 agencies. So blending has happened, and I will be drawing by the end of this month the entire money. So projects are there. IFCL on sustainability, IFCL has already put in place environmental and social governance aspect since beginning. Recently, we came out with ESG and sustainable financing framework. Thereafter, we came out with our climate strategy as well. What is to be done now? So we have taken 20%, at least for the current year, 20% disbursement has to be for green infrastructure. That includes renewable energy. Going forward, we have been increasing 25, 30, 35, and 50 by the end of 2030. It is in line with the Government of India's mandate. See, in India, infrastructure sector started taking shape after IFCL came in. And this is only the institution which can lend into all the infrastructure sector. There are 5, 6 infrastructure companies, but they are into either railways or solar or specifically energy sector. So there was a need, and the government has again came out with another institution, seeing that capital requirement or investment requirement in the country. And now, along with that, government and institutions in India, they are very concerned about sustainability aspects as well. So we have been targeting those projects, and we are mentally prepared and planning to have some kind of concession for the developer, so that project cost may not be any additional burden for project developers. So we have been working along with the developers. Coming to the point, multilateral banks, we are getting loans in either USD or can it be possible in the local currency so that I can match my cost? If I add hedging cost and government guarantee and their interest rate, it's sometimes become unviable. Of course, till now we have borrowed 2.5 billion USD, but still this is the concern for us because it should not become, seeing viability of the project, it should not become unviable for institution as well. So one thing is, can the loan is available in the local currency. Secondly, can this loan, early stage capital, can be provided by MDBs. So these two aspects, if it is taken care, and a lot many talk about project initiation and early stage assistance, technical assistance. Apart from this, two aspects, if it is taken care in local currency and guarantee is waived by the MDBs. So then I think there may not be any issue. And from IFCL side, we are allowed to associate with any of the institutions which are into infrastructure lending, and they are helping us in infrastructure financing.
Thank you very much. You had brought another topic that is being discussed quite a lot, which is this availability of early, in the early stage, local currency, long-term financing, and then perhaps and I would highlight that being from MDB, and this was one of the topics that all MDBs got together in the viewpoint note. We summarized the lessons and an effort on how local currency financing could be more provided by MDBs. So this is an area of a very important work. I think here, we are short of time, but I join the others also wishing all the best to the gentleman that was here. Good news that he survived. He had a good care and assistance. But I want to thank all the panelists, thank everyone for coming. Thank you very much. Yeah.
Together with any other remaining speakers, because there wasn't time to have a photo at the beginning with your earlier panels.
Between the national development plans and the 10-year implementation plan. And also the regional economic communities plans are also aligned. I'll come to your question, to our second 10-year implementation plan.
Yes.
It's very important to understand that, because at the planning stage, we are coordinated. There is harmonization,
Yes.
and there is just one plan. Then, we need to have all the financing institution also to align their finances to the priority areas that are already stipulated in the second 10-year implementation. And that's where I would come. And I've been hearing all the discussions before. I guess, we have an issue in terms of the NDBs. The NDBs are really the vehicles to drive these big investment vehicles for us. They're important and we need them. But, we have got 95 plus, NDBs in Africa, which is 21% of the whole entire development banking in the world, but with 1% asset
100%.
of the world. And therefore, capitalization is of great importance. And de-risking is very important. And then, just to articulate on that, and these NDBs need also to have a coordinated, approach, and we have got so many of them fragmented everywhere. And that is not only the development banks, it's also from the climate financing. We have
Exactly.
got many instruments, but they are all fragmented. And therefore, we need to have a coordinated, and really organized way of responding to the priority areas of Africa. And that's where,
100%. And I completely agree with you there, Minister. I do want us to acknowledge that Mr. Salzman does need to leave because he does have an urgent meeting with the South African government, Mr. Suzman, as he's mentioned. But it does take us to an opportunity as well just to build up and conclude on some of the key themes that need to be mentioned by all of the panelists as we do conclude and primarily focus on the outcomes of what has been mentioned, which is the vision for financial architecture fit for sustainable development. And I just want to give each panelist at least 15 seconds to tell us what is the one commitment to ensure that as we move forward from the conference, which will end in 3 days' time, there's an outcome that we can attain in a year's time that would have shifted the dynamic in terms of attaining sustainable development goals. So what's the one thing perhaps that needs to happen from a fiscal point of view, government, institutions, and policy to make sure that we shift the radar? 10 seconds each. Minister?
Maybe 15 seconds.
Okay.
I think we have to work on the financial governance of the world. So 20 seconds. And that it is important that we continue to promote multilateral institutions, IMF, World Bank, multilateral development banks. And in that regard, let me repeat how important finance in common is, because that put together more countries or almost as much countries as the UN with very powerful institutions. And we have to continue, and Remy, I count on you to continue to lead that marvelous initiatives.
Fantastic. Thank you so much. If we have your perspective in 15 seconds.
Since 15 seconds, so let me concentrate on new generation platforms, such as the Brazil Investment Platform, because they should be government-led, aim at economy-wide, and be a locus not only for projects aligned with programs, but for information and connectivity, so that they are able, as Mark just said, to cater for different sectors and phases of projects. And they rely on national development banks. In Brazil, it's settled on the BNDES. I would like to conclude with that.
And 2. Thank you. Dario, your perspective in 15 seconds.
3 points. First, climate financing will remain there, despite the fact that it's not very popular at this point in many parts of the world, simply because the climate is changing. Second point, cooperation among us needs to be improved, among bilateral and multilateral. Third, a key aspect is the involvement of local partners, because in this way you allow sustainable growth.
100%. Thank you so much, sir. Your Excellency, very briefly, the one key objective we need to work towards in 15 seconds.
Well, as the African Union, we have got 3 major initiatives to really make the institutions fit for purpose, the financing institutions. There is this proposal for the creation of the African Monetary Fund, which is very good in terms of, addressing the imbalances on the balance of payment. There is also the intention of creating the African Central Bank, which is also very important in terms of the ultimate goal is to have just one currency for Africa. That would really help us de-risk. And the third one is the credit rating agency, which will really lower the cost of capital for Africa. So these are the 3 instruments that we would like to put in place as we go on in the future.
Thank you so much, Your Excellency. They all lead to very robust debates that do take place, but ultimately from a policy point of view, we certainly see the outcomes and objectives. We certainly do see the practical examples as to how it is being implemented within different countries and regions, and most importantly, making sure that despite the uncertainty that might exist within the respective markets we operate in, we continue to work within a manner to attain camaraderie and partnership right across the spectrum. Please give my panelists a round of applause before they leave the stage. Fantastic. I do understand that as we do conclude this particular session, there will be a photo opportunity with the various partners and previous panelists from the discussions that we had earlier. They'll be joining us on stage for a photo opportunity. You, on the other hand, can only stay and join, but most importantly, do make sure that you continue to follow through with the details on the program that are available to allocate yourself to the conversations that will be taking place tomorrow here in the main plenary, but also on the sidelines. Two of my colleagues, Jimmy Moyaha and Stephen Grotes, will be guiding you through many of the plenary sessions that will be taking place over the next 2 days. But it's quite clear. The objective is for us to partner, align, and of course make sure that we meet the objective of investing into critical infrastructure. Thank you for joining us on day one. Our panels, number 1 and 2, will join us for a picture opportunity. So if they are still present, please do join us. To the rest of you, ladies and gentlemen, have yourselves a wonderful day. Thank you so much. I think you might have to move.